The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So here we are, it's Saturday, and we are doing this remotely. I'm in self-isolation. I took my computers, I moved them home. I took some other equipment and moved it home. So we're doing this remotely. So stay with us. If things don't work, you'll know. If things do work, you'll know that too. So I want to talk about this. You know, we're living in a very difficult time. I don't have to tell you that. You know that. But I really want to be clear, because the contract I sign with each and every client is the same commitment I make to you as the listener. For each and every client, I only talk about two benchmarks to measure their accounts against. The Standard & Poor's 500 total return. That means the dividends are reinvested. It's the maximum Standard & Poor's 500 index. Also, the Barclay aggregate bond average for people that have bonds in their accounts. And we do a combination of 50-50 if they have both stocks and bonds. And my goal for each and every client is to deliver superior returns. My passion is to create and maintain wealth for my clients. That's true in good times and times like this. And my guess, having been in this business for 33 or almost 34 years now, is that there are a lot of financial advisors who are hiding in the desk or hiding in their homes. They're not answering phones, or if they are, they're mostly holding hands. They're mostly keeping people and talking to people through this whole process. You know, the surprising thing to me during this whole process is that my clients are actually sending in more money. They're taking money from other brokerage accounts. They're taking money from CDs. I have one client and maybe two that are cashing out annuities to send the money in. All of those have happened in the last few weeks or are in the process of happening now. Clients realize and understand what it means to buy low and sell high. And my message is pretty simple. I have a passion for creating and maintaining wealth. And my clients know it's not just words. It's not just a spin. It's real. And the benefit to my clients is really obvious. It's more money for their retirement. It's more money for their children's education. It's more funding to get through these very difficult times. And I also want to say, as I'm sitting here in my kitchen, I'm spread out on the island in my kitchen, that one aspect of what we do, we saw with the Twin Towers come down in New York, is to talk about business continuity. And what I did is I packed up my computers. Could have easily been 2 hours, but I kind of docked it. It took me about 3 or 3.5. Set those up, and we were running. One small glitch that we resolved is client data is very, very highly protected. We don't want anybody to break into client data, so we had to set up a special VPN at my home computer to access that. Otherwise, it's been business as usual, or kind of usual, as best we can, but it's business continuity. So we're living in a very difficult, different time. So I want to be clear. My goal for each and every client is to deliver superior returns, true during these times and true during good times. So a lot of what I have to say today as I do this program, or especially in the early part of the program, I'm taking and drawing on a book by Annie Duke called Thinking in Bets. Because in today's market, like very few other times, during a black swan type of market, we're faced with a lot of decisions. Clients are faced with those decisions, but financial advisors are faced with those. For me, it's looking at each and every stock, how companies are going to do on the other side of this virus. What's going to happen? Which are going to survive, which are not going to survive, which are going to have a good run once they come out of it, how many are not. I had a neighbor once who had a restaurant, and he said during one of the recession times, it was a recession, and he said, during recession times, I'd rather be a car dealer than a restaurant owner. And I said, why? He said, because if people start through a recession and they intend to replace their car, what they do during a recession is they'll do repairs, they'll delay, but eventually they're going to replace their car. They're just delaying the decision. But with a restaurant, if you don't go out to eat today, you don't say, I'll go out in 6 months. No, what's lost today in a restaurant is lost forever. And yeah, as we do the stay home bit, what's going to happen is a lot of people will, once it all goes away, you'll see long lines to get into restaurants and long reservations, but that will pass away. That's going to be a short-term thing. It's not going to be people making up a month or 2 months or 3 months of not going out to eat. Once the business is lost, it's lost forever. And so it's important as managing stock portfolios to look at each and every stock, each and every company within the portfolio, and determine what's going to be the impact of COVID-19 on this company going forward, and what has been the impact during this time when we've got this stay at home and we've got a market that's cratered in. You know, making good decisions, making great decisions. And what makes a decision great is not a great outcome. Decisions that result in good answers are because of a good process. It's a process that attempts to accurately represent our state of knowledge, and that state of knowledge has to be some variation of, I'm just not sure. Whoever thought there was going to be a COVID-19 pandemic cannot say for sure what's going to happen on the other side. And Duke points out in her book that good decision makers are confronted with a world of being uncertain and unpredictable, and they're comfortable with that. I feel that. Even though you don't know what's coming out on the other side, even though you haven't looked and you don't know, you simply don't have a crystal ball. You never know for sure how something's going to turn out. But as a decision maker, as a portfolio manager, it's important to embrace that uncertainty and figure out how uncertain you are. The best guess will depend upon the different circumstances and how they turn out. And the process depends upon how much information you have and how experienced we are. You know, looking at COVID-19, what we know, I've talked a few times on the radio about Spanish flu, several times on these programs. It was the worst of all pandemics, worse than the Black Plague. 15 million people died worldwide. The transmission was probably similar to the transmission we're seeing with COVID-19. And I looked at what kind of actions reduced the number of deaths, what kind of actions reduced the number of sick people, and what kind of actions applied to COVID-19. And finally, what was the impact on business? What happened to businesses after Spanish flu died out? And it did die out. It died of its own death. It died when enough people had contracted the virus and died, gotten sick, some got over it. But what happened to business? All of that adds to information. You know, I think about that, and I think how many other people really study that? How many financial advisors really understand, have studied the Spanish flu? But not only Spanish flu, black swans. We're living in probably a black swan world. We went through the 1987, that downdraft on October 19th, 1987, we went through the dot-com time. We went through the Great Recession. But those weren't the only times we've seen black swans. We saw it in the Great Depression, the 1930s, but that wasn't the only time either. We saw it in 1792, in 1819, in 1837, 1848, 1874, 1890, 1893, 1907. All of those were black swan times. The question is, what did businesses do? What did governments do? Most of the times there was a government surplus or stimulus, a stimulus to stimulate business. The only time there wasn't was during that 1874 to 1913 time period. There was no stimulus, and it was an extremely hard time for most people. Think about what we went through in 2007 and 8. That's what it was like living through that time period, and it wasn't a short time period. 2007, 8, and 9 were less than 3 years. The Great Depression was a number 6 or 7 years. Back in 1874 to 1913, that was almost 30 years. And every other year was a recessionary year. It was very hard. But it was also a time in which people moved from the farms into the city. At the beginning of that time, all the people were working on the farms, 50%. And so we saw an industrialization of the U.S. Business rose. So all of that is information. All of that goes into the evaluation of what's going on. Stay with me. We're going to come to a commercial break. Don't go away. We've got a lot more to say about this whole thing. Don't go away. If you missed this program or some of the other programs, you can check out our website and look at the podcast. You can also find it on YouTube.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about this whole process, this whole COVID-19, and the process that goes into making decisions, because decisions are crucial and important during this period of time. This is not a time to sit back and say, let's see how things are going to work out. Let's just see if things recover. You know, there's thinking or hoping for things to work out, hoping without action is a comforting illusion. It's not, it may make you feel good, but it's an illusion. This is a time for making decisions and making decisions correctly. It's a matter of time of having the proper input. You know, when you think about this, when you think about where things are and you do studies, you can see that maybe other decisions you make are maybe better. But a second best decision is better than a third best decision. A third best is better than a fourth best decision. All of it comes down to seeking the truth. And most of us think that we're open-minded and capable of updating belief, but the research shows that's not true for most people. Most people will look at information and fit it to our own beliefs. Daniel Kahneman, in his book, Thinking Fast and Slow, said, we want to think well of ourselves. We feel the narrative of our life story is a positive one. And so when we're confronted with new information which might contradict our beliefs, we have two options. We can either make a massive shift in our opinion, or we can ignore the information and discredit the new information. So where I am in my process is I want to look at all the information that comes in, and I'm ready to make a shift if I need to make a shift. I'm ready to say, I was wrong about that. I don't believe that happens with most other financial advisors. I've been around this business long enough. And I don't want to be critical of other people. I just want to say there's things that don't happen other places. So people, according to Thinking Fast and Slow, when they get new information that agrees with what they believe, they embrace it. I like to illustrate the capacity for some people for self-deception. I illustrate it with reasons people give for automobile accidents. Here's some that are actual reports on automobile accidents. Quote, I collided with a stationary truck coming the other way. That was one response on describing an accident. Another response describing an accident was, a pedestrian hit me and went under my car. A third answer to an accident. The guy was all over the road. I had to swerve a number of times before I hit him. Think about this answer. An invisible car came out of nowhere, struck my car, and vanished. Yep, sounds reasonable. Or how about this? The pedestrian had no idea which to run, so I ran over him. Or this, the telephone pole was approaching. I was attempting to swerve out of its way when it struck my car. Those are all actual answers for people describing the accident they had. You can see how wrong they are. But Stanford law professor and social psychologist Robert McCown said 75% of victims blame someone else. And in multiple vehicle accidents, and he was studying automobile accidents and how people describe the accident. In multiple vehicle accidents, 91% of the people involved blame someone else. And even in one-car accidents, like those examples that I gave, one-car accidents, 37% of drivers blame someone else for the accident. It's pretty amazing when somebody can blame a pedestrian that they hit. It's pretty amazing when somebody can blame a telephone pole. It's pretty amazing when somebody can blame a stationary truck. But those are actual answers. So I think it's really important to look at the data and the information. And we're living in a time when we have to look at that information and there are decisions to be made. I'm willing to admit I'm wrong. I'm kind of a data freak in the I'm weird in that kind of way. When I was between my undergraduate degree in math and my master's degree in business, my MBA, I had a summer job at Pacific Gas and Electric. I've told this story before. So Pacific Gas and Electric was a large utility in Northern Cal that supplied electricity and gas in Northern California at the time, become famous because of the fires that became their responsibility. But at that time, Pacific Gas and Electric was a major utility in Northern California, one of the largest utilities in the U.S. And forecasting electrical consumption into the future was very, very important, because if you overbuilt and built too soon, it meant that you issued bonds and you were paying a lot of interest when you didn't need the power. On the other hand, if you built facilities too late, it meant that you ran out of electricity and you had brownouts. So forecasting electricity demand was an important aspect in this department I ended up in. And in this department, the way that it had always worked in the past is you took out last year's forecasting book, you counted the number of dividers in the book, and you figured out that was the number of dividers that went into the new book for this year. And then you looked at what was done last year, and you kind of extrapolated it forward. But by the time I got there, the computers were coming into effect. You started to see computer analysis. You were starting to see things happen like linear regression. You know, when people talk about correlations, all of that comes out of linear or collinear variation and regression. And that's what we began to look at. With linear regression, what you're saying is this variable causes this. What happens if you change one variable? What happens to the other variable? And that's what we were looking at. And being a brand new technique, brand new technology, something new to apply, we were throwing in all sorts of data. Any data you could collect, we were throwing into the hopper. We were trying to use linear regression to project electrical demand and electrical consumption. And what we found, the best predictor, a 97% correlation to electrical power consumption, 97%, was the number of prisoners on Alcatraz. Now, if that had been true, today there's no prisoners on Alcatraz, there'd be no electrical consumption in Northern California. So you know that's not true, and I knew that's not true. And even when we ran that regression, we knew it wasn't true. We thought it was kind of funny, but I learned a lesson from that. I learned when you're looking at data, you also have to be aware of a causal relationship. When you look at ice cream consumption goes up in the summertime. There's a causal relationship. The weather warms up, and that is a reason that we consume more ice cream. So all of this comes into play because, in my opinion, we've entered a black swan universe. We went through the October 19th crash. We went through the dot-com crash. We went through the Great Recession. And here we are in 2020, we're going through the COVID-19. Nobody saw those. They're random events. They're considered negative. They're random, completely random events. When you have, and the black swan comes from the concept that when you have a lot of swans, every once in a while you get somebody with one of the swans with a regressive gene who turns out black instead of white. And it's kind of random. You can't predict who's going to come out with a black swan. And for me, it's a black swan universe, both in a positive sense and a negative sense. Who could have imagined what the impact of computers would be, or that we would even have computers? Who in the 1940s would have predicted that? You know, back at the time of World War II, you had some very large guns. And in World War II, during the fighting, you had some people sitting in a room doing calculations. From the field, people would call in with information on the wind and the distance and those things. And you had people sitting in a room that would calculate how to aim those guns. And in that respect, the Army went to a company and said, can you build us a machine that can do what those people are doing? And the person said yes. And they built a machine. And the people in that room, their job title was computer. And now you know where the name computer comes from. But at the same time, Tom Watson was head of that company, IBM. And when he testified before Congress, they asked him how many machines he would build. And he estimated the most machines they would ever build was 15. Can you think about that? 15. Who imagined in the 1940s that almost every home would have a computer? That we would have computers in our cars? That we'd have computers in our toasters? We would have computers in so many aspects of our life. That's a black swan on the positive side. But what we're seeing with COVID-19 is black swans on the negative side. So how do you deal with that? How do you really deal with that? That's what this program is about today. That's what we're going to be talking about. And we are coming to a commercial break, so you don't want to go away. I want to talk about black swans, living with black swans, and how you deal with it. Don't go away.
About money, with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So we live in a black swan universe. I've been talking about decision-making. I've been talking about and began to talk about black swans. But we truly are living in a black swan universe. A black swan on the upside. I talked about computers in the lab before the commercial break. But we're living it with COVID-19 in another type of black swan that's affecting people and businesses on the downside. And for me, it means a lot of ideas that we've had may be wrong. Modern portfolio theory is the most widely employed investment strategy. Sounds wonderful, sounds logical. Modern portfolio theory. It was born out of work that started at the University of Chicago in the 1960s, where they were trying to quantify stock price movements. Actually, if you go way back, it started with Fisher before the 1929 crash, but it really got going with significant emphasis in the 1960s at the University of Chicago with Mark Wetz, who came up with the idea that stock prices move based on intrinsic factors of the company and the market. When the market goes up, most stocks tend to rise. There's an old Chinese saying that was written in a book 5,000 years ago. That saying's been attributed to John F. Kennedy. It's been attributed to Warren Buffett. But it says, a rising tide lifts all boats. It's a saying that goes back 5,000 years ago. But that's been applied to the stock market. When the stock market is going up, it tends to raise all boats. And what Mark Wetz says is that's part of the movement of a stock. In addition to which, there's the alpha factor, which he says is intrinsic to the company itself. And growing on that, you had additional work being done from everybody from Maglione and Miller to Fama to any number of names who have come out with building this idea of modern portfolio theory. But what it is really theory, because it's based on incorrect statistical assumptions, and I'm going to talk about those in a minute. But in my opinion, modern portfolio theory sounds great as a theory, but it's never been proven in reality. And it doesn't do the correct thing for black swans. These random events come, but they're not part of modern portfolio theory. So the question is, how do we deal with it? There's a thing that bad things sometimes happen to good people. How do you recover? How do you get through it? How do you make sure that these crises don't destroy you? I mean, 1987, the dot-com bust, the Great Recession, COVID-19, every 10 years or so. And it's probably going to continue to be true. And like the Great Recession, I don't feel that we'll repeat that for a long time. Like COVID-19, the pandemic, we probably will deal with the next pandemics better. But there will be another black swan. There's something that nobody foresees today. I don't foresee it. No one else probably foresees it. But it will come, and it will do the same as we did on this. Market goes down 30% and creates a huge worldwide reaction. And then we need to, if that's going to be true, we need to know how to deal with it, both on the upside and downside. You know, how do we keep going? How do we say? Where do we go? You know, I don't want to be someone who says in 2022, I wish I would have made this decision in 2020. I want to make my best guess today based on the information I have, based on knowing things are uncertain, based on knowing that if I make a bad decision, I can turn around and reverse that decision. That's what we have to do. We have to take as much information as possible. We have to plug that into knowing that our decisions are in an uncertain world, and even if we make a good decision, it can be wrong. You know, when you think about it, I'm always amused when I look back at the Great Recession, because there's dozens of people who say that they saw it coming. Dozens of people. You know, in November 2006, I did a newsletter, and I talked about the real estate market and it being overvalued. And I talked about real problems coming because loans are being made on a ninja basis. No income, no job, no assets. That didn't matter. If you could sign up for a house and you wanted to buy a house, the banks didn't worry because home prices were increasing at 14% a year. So after a couple of years, if they had to foreclose, the home prices would be up 25 or 30%, and so they could go ahead and foreclose and turn around and sell the house for a profit. So they didn't worry about whether you had any income. They didn't worry if you had a job or any assets. They didn't worry if you could pay for the house and make the house payment. You know, we had examples in Bellevue of taxi drivers buying huge condos in the new condo buildings going up, where their monthly salary, where their monthly payment was less than the yearly salary. We had instances of that, and I pointed that out in that newsletter. Not that particular instance, because that didn't come up until later, but I pointed out we were headed for a credit crunch. I never saw a credit crisis. I didn't see when I wrote that newsletter in 2006 that a credit crisis would be coming along. But there's dozens of people today who had as little information as I did, and who said as little as I did, who now claim they saw the credit crisis coming. Maybe there were a few, but I don't think most did. I think it took almost everyone by surprise. I think with the pandemic, there were some people who were concerned about a pandemic, but no one really saw it. We saw a lot of things happening coming in the past. We saw swine flu. We saw SARS. We saw MERS. We've seen Ebola. We've seen those kinds of viruses which could have created a pandemic, and yet in each case they died out fairly quickly. Who really thought that we were going to see a pandemic in the magnitude that we're seeing with COVID-19? I would guess that in 4 or 5 years, there'll be a dozen people or more who say that they saw it. So how do we deal with it? How do we deal with it? Now, the best way is, if you see it coming, sell out of everything, wait until it's over, and wait until we reach a bottom in the market and buy back in. All you got to do is be able to foresee that we're going to have a pandemic, and then realize we're at the very bottom of the market, so we're going to buy back in. Sounds simple. Sounds straightforward. All you have to do is have the vision to understand we're going to have a pandemic. Have the vision that we're going to have a Great Recession. Have the vision that insurance programs, computer programs, are going to kick in and clip 22% off the Dow. Have the vision to see that we're going to have one of these other black swans, the next black swan. But we won't have that vision. The chances are we'll get right. The next black swan that comes along after COVID-19 is going to be one that happens the same way. By the time we're into it, the market's already going to be down a lot. So if it's already down a lot, what do? I remember going to a cocktail party. My wife was a French teacher. And at the party, there was a teacher. This was during the dot-com days, after the dot-com bust. And one of the school teachers mentioned that she had lost 90-some% of her portfolio. She was not a client of mine. She wasn't then. She has never been. But she mentioned that she'd lost 90-some%, 97 or 98% of her portfolio. And she said she's never going to do stocks again. She is going to buy CDs. And I thought, wait a minute. You've taken a 98% loss, and you're going to lock that in by doing CDs? And you'll never recover in your lifetime to where you were before. Selling out at the bottom or selling out on the way to the bottom and then locking in a stable value fund is not going to get you back to where you need to be. It's not going to give you the income or the net assets of getting back to where you're going to be. So what do you do? How do you handle it? That's a question. And as we come to the next segment, we're coming to a commercial break. After the commercial break, I'm going to talk about what do you do? How do you handle this? We're in this whole process. We're in a process of dealing with a black swan. It is a current one. We're in the middle of it. How do we handle it? What do we do? How do you handle the next one? Because the chances are there will be another black swan. Not in a year, not in 2 years, but sometime down the road. 3, 5, 8, 10 years, there could be a black swan. And of course, if you've been listening to the program, you know that I think that we are coming to a time where we're going to see a very high rate of inflation. It's not going to be a black swan kind of thing, but it's probably going to take a lot of people by surprise anyway. How do you deal with it? We're going to be talking about that when we come back, so don't go away, right after the commercial break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about black swans. I've been talking about what we're going through, the COVID-19. You know, it's one that we've lived through. This one we lived through, the Great Recession we lived through, the dot-coms we lived through, in 1987 we lived through. Previous times we lived through those. I wasn't an advisor during those times. I wasn't a stockbroker during those times. But how do we handle it? So my opinion is the risk is being out of the market, not in the market. There was a study done by Peter Lynch and John Vander Heyden looking at the market from 1981 to 1991. And yeah, there was no black swan during that time. But they said if you missed the best 10 days during that 10-year time period, your return was 4% versus 14% per year for just staying in. Carla Freed did an article for Money Magazine that she published in August of 2007 that said for the time period 1982 to 2001, the Standard & Poor's was up 11.8%. And remember, she is dealing through the time of the dot-com bust. During that period of time, 1982 to 2001, 10,000 invested in the market would have grown from 10,000 to 93,000. But if you miss just the 10 best days, just 10 best days out of 20 years, one best day every other year on the average, instead of 93,000, you'd have $56,044. If you miss the best 30 days, 1.5 days per year, instead of 93,000, you'd have 28,144. If you miss the best 50 trading days, 2.5 days on the average out of 20 years, instead of 93,000, the 10,000 would have grown to 15,000. And if you missed the best 60 days, you would have had a negative return. So yes, it's true that you can improve your returns by missing the worst days. But trading and knowing which days you should be out and which days you should buy back in means you have to guess correctly. John Bogle, the late Jack Bogle, who founded Vanguard, said in his over 50 years of being in the financial markets, he never knew of anyone, nor did he know anyone who knew anyone who, on a trading basis, delivered consistently superior returns. Trying to guess in and out. You have any number of people that do that. You know, the fact is, if you miss the worst days, and only hit the good days, you can improve your returns. But I don't know of anyone who's ever done that. Dalbar does a study, and they look at how individual clients do in mutual funds versus how the market does. And what they find is individual clients moving and trading their mutual funds do half as well, or less than half as well, as if they would have just bought the S&P 500. That's why I believe being in the market is the right time. And because I do well for my clients, I think I can do better than the Standard & Poor's. And my results show that. And past performance is no guarantee of future results. So where are we now? COVID-19. Let me tell you, Edward Renshaw of the University of New York in Albany studied all the times from 1872 to 1990. He found that 42 times during that time period, the market dropped anywhere from 5% to 40%. All that time, from the Civil War until 1990. And he found that 29 out of those 42 times, it happened during a recession or a depression. 13 times you had a drop that came during good economic times. Think of 1987, 1989, 90. Think of 2020. These times have come during good times. Whether it was a good economic time or a recessionary or depression time, the recoveries were eerily similar. What happened is a third of a drop was recovered within 3 months, 1/3 of how the market dropped. And then it could take up to 12 months, sometimes a little longer in recessions or depressions. It could take up to 12 months to recover the rest. If you look at 1987, the market was down 37%, and it total recovery in 9.9 months. But 23% came in the first 3 months. In 1990, the market was down 13%. It was up 29% after 12 months. So in 2008, the Dow was down 33%. It got from 13,900 to 6,600. It took just 3 months to get to 9,100. You know, that was true of the Standard & Poor's as well. There's no guarantee that we'll see the same kind of return coming out of the COVID-19, but there's some reasons to believe it. There's some reasons to also understand that fear sells. You hear from companies that are I hear from companies all the time that are soliciting me to sell their products. Stable value funds, stable value things, buy an annuity, lock in your losses. That's what they're really saying. Oh, why should I lock in my losses? Annuities, CDs. I told you about the teacher, and it makes no difference. I went to a 401k conference back just after the 2007-2008 time period. There was a mutual fund wholesaler there that was trying to sell stable value funds. We're very close to the bottom of the market. Actually, it recovered some. He wanted to lock in those, and they didn't say that, but essentially by buying a stable value fund, one that's not going to increase, you're locking in your losses. You're never going to recover that. So it's absolutely, the question to ask is, will you have regret in 2022 for what you do now? 2022, think about that. Ask yourself, 2022, will you look back on this time and regret what you did? During white knuckle times, during these times when the market is really sold off, there's an old expression that it's a white knuckle time. When you're hanging onto the sides of your chair so tightly and with so much fear that your knuckles are turning white, it's usually the very best time to sell, or best time to buy. I'm sorry. It's one of my clients. My clients are sending in money. They're liquidating in one case and maybe another. They're liquidating annuities that were sold by other brokers. I don't sell annuities. I never sell annuities. They're liquidating from other brokers. They're taking money out of other brokerage accounts. They're taking money out of CDs to send it in because they realize now is one of those times to buy low, sell high. Fear sells. Look at the data. And just because it feels good at this time, will it feel good in 2022? If you do, if you look at these things, if you take all the data, and I talked early in the program, I looked at the Spanish flu and the pandemic and the impact it had on the people, on the deaths, on how it spread, and what it did to business. I looked at black swans, 1987, 1930s, 1792, 1819, 1837, 1848, 1874, 1890, 1893, 1907, 1931. All of those were black swan times, and all of those times, business came back and did well. You have to look at what the impact is, and you have to look at the companies. There's companies that some don't survive the black swans. So it's important to go through one by one the stocks you own. That's where we are. That's why it makes sense to look at this as one of those black swans, but we'll be out on the other side. Have a good week, a good weekend, and I hope there's some encouragement from all this. I'm positive going forward. I hope you will be too.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.